We're joined on the show now by Will Hobbs. He's Vice President for Research, Economics and Strategy at Barclays Wealth in London. Now, Will, to begin with, Italy has done quite a bit so far to get its finances back in order. But in order to break the country's low-growth, high-debt spiral, the International Monetary Fund has come out and said that more needs to be done. But the question is, what more can Italy do?
Yeah, well, first things first, Italy has come a long way under their more credible leadership, or perhaps less incredible than his predecessor. Mario Monti has done quite a good job in pushing through labour reforms and recently spending cuts. And I think the important point to make about these reforms is that they're going to take a while to actually have an effect, I think. So we won't, in the short term, probably things are going to get a little bit worse for Italy because of these reforms. But longer term, we still think that they're going to be better set for growth. The other thing to make about the IMF statement, the other point to make about the IMF statement is that one of the points that they make, or one of the most significant negatives they make, is that if the eurozone crisis worsens significantly, then Italy's going to suffer. And that's kind of an obvious point to make, and it's not really in Italy's control. So really, what we need to see for Italy's sake is that the policymakers, look on top of the crisis. And for the moment, it looks like the policymakers are starting to make the right sort of steps in the right direction.
Now, Will, Italy's bond yields are seen breaking above 7% in the absence of timely action from the EU. Now, should yields go above 7%, what is the effect you see of that on bond markets across Europe?
Yeah, it's an interesting question because, there does seem to be a sort of magic 7% figure that people tout around on sort of bond yields, 10-year bond yields. I think the important point to make here is that there is no magic level, in a sense. Italy's yield can go up above 7% or, even further than that, possibly. But the important point to make is how far or how long the yield remains above that level.
Right, so sure. Now, Will, while policymakers in Europe agreed at the end of June to work together to fight the crisis, the events unraveling over the last couple of weeks seem to suggest that by the time politicians are done finalizing their plans, the eurozone may be beyond redemption. Would you agree to that?
No, I don't think so. It's interesting, the summits that we've had, and there seem to be innumerable over the last year and a half or so, it's been very much a trend. You've had the summit and then you've had a sort of rather loosely worded, vague statement coming out of it. The markets have rallied initially just on the sort of prospect of the politician doing something, but then once the markets have had a chance to digest the summit statement, markets have tended to drift again, and this has been very little different. However, this time round, the summit's been followed up by the Eurogroup meeting, where actually it does look like they're going to follow through on some of the promises that they made at the summit. And I think, it does seem to, it's starting to seem like the politicians are starting to get a handle on what needs to be done and are starting to make steps in the right direction to doing them. The idea that they're focusing on the banks now is very, very important, and the idea of a common single bank regulator is certainly, I think, a massive step in the right direction.
Right now, Will, we are already seeing a delay in Germany's support to the European Stability Mechanism. It's stuck in court with no clarity on when the final nod will come. Would you say aspects such as these simply dent the confidence of the markets in the ability of policymakers to get their hands around the problem at hand?
Yeah, certainly markets do feel very nervous, don't they, about how Germany responds. And Germany has provided, throughout the crisis, a sort of, the dragging feet, I guess. But it's kind of understandable from Germany's perspective. They're looking for assurance, or even better, proof, cast iron proof that the same isn't going to happen again. That, the spending policies of some of their neighbours aren't going to differ so widely from their own. And I think, they're going to want more assurance that fiscal integration is happening before they commit further to the crisis. But I still think that, we still think that, it's in Germany's best interest to continue down the road to integration. And while it is in their best interest, I think, they'll probably still reluctantly sort of come to our aid.
Now, Will, would you say that the events playing out across the eurozone will have a profound impact on the Q1 earnings of European companies?
I don't know about profound, but certainly for both US and European earnings. we're certainly going to see some impact, I think. There was noticeably some companies already talking about a significant drop-off in business activity at the end of the quarter, and that was most likely down to the ongoing eurozone crisis and the lack of confidence that sort of propagated.